Good afternoon, everybody. My name is Todd Jones. I am the Director of Investments for Gratus Capital. Thanks for joining us this afternoon, March 31st at 2 p.m. Well, we're calling this Market Matters. This is going to be a weekly webcast for clients to tune into that are interested. We're going to try to share new observations and new insights every week. So there's always something different and unique going on. This week will look a little similar to last week in that we'll be presenting some similar data sets just to show you what's changed in the 1 week time period since we did this last time. But going forward, our hope is that we start to tailor some of this web series to cater to some of the questions that we're receiving or more in-depth topics that you have on your mind. So for example, I know one of the ideas or questions that's been on some clients' mind has been, is it time to look at gold as an asset category? So I will plan on putting a presentation on gold together, just give you our perspective on that, just to walk you through that. And I'll lay out, hopefully a few weeks in advance, what the longer term agenda is for each of these coming up in the future. So hopefully you can tune in for the foreseeable future every Tuesday at 2 o'clock. Look to see you there. So with that, we're calling this Market Matters. And today is March 31st. We held our last one the 23rd, and a lot's changed. But let's go through a very similar agenda from last week. First thing is we're going to go through where we stand with the COVID-19, what the fact pattern continues and how that looks from an evolutionary standpoint. We'll look at current portfolio positioning and then longer term positioning ideas. So let's kick it off with some of the COVID-19 fact pattern. I would say, of course, that one key assumption that we need to make around this COVID-19 is that that we all adhere to some of the guidelines that are being set forth. And I think the more that we can adhere as a society to some of the guidelines around social distancing, hygiene, and association, the quicker this thing will resolve itself. And I think with some of the data that I'm about to share with you, you'll see how that can be possible. In addition, there are some great resources we found. I'm not going to share them here in this presentation today, but if you would like to see some of the articles we read about COVID-19, which are useful, or videos, we'll be certainly happy to share that with you. So please reach out to your wealth advisor, and we'll send you a list of those items. So let's take a look. So this chart, very similar. Actually, this is still same chart from last week, but I did want to make sure that we had some context for the current situation. Europe continues to be ground zero. And just for orientation purposes, for those that weren't able to join last week, you can see the rate of new infections over the course of time. So from the time that COVID-19 was discovered in the country till days after, you can see the progression in days, and then on the vertical axis, the number of infections. The U.S. rate obviously is a bit higher than it was on March 18th. It's probably up around 100,000. Most of these lines are a bit higher than they were, although they are starting to. The good news is most are starting to level out in countries that are of significant economic consequence, with a few exceptions. Obviously, U.S. continues to have a pretty rapid growth, but that is pretty typical for the fact pattern right now of how this virus progresses through a society. It does appear, based on the last 2 or 3 days, that the Italian rate of infections is starting to level off, which is very positive. Same with Iran. And I did want to highlight here, so the US is down here, Iran is over here, Spain, Switzerland, Norway, and then Italy right here. I did want to highlight again, and I'll show you why in just a moment, both the South Korean response and the Japanese response. And this is critical because it does give us a way forward to how to look at COVID-19. And I think this chart right now that you're seeing shows exactly why we should be focusing on what's going on in South Korea. And Japan very similarly. It's because of this chart right here. So again, days of infection from day 0, when COVID was, discovered to be a problem in society, the infection rate, but more importantly, the decline in new infections. And I think this is really interesting because it does say that once, if you take serious measures to address this very serious issue or health crisis, that this can be resolved in a fairly quick manner. But you have to have a few things. You have to have universal buy-in, and I don't think in the US right now, all states, particularly Florida and Texas, are really big, are buying into the severity of the crisis, as are states like Virginia or Ohio that are now closing schools through May and June. Texas and Florida are still holdouts from a closing of business standpoint and closing school, which is a little unfortunate. But what this chart shows you here is taking the Chinese baseline of the blue lines and overlaying it with the South Korean baseline. And then, of course, Japan is on here as well at just a much smaller amount, that we can have a resolution to this new infection rate pretty quickly within 40 to 50 days. But again, the key is testing and universal buy-in. The US is getting, now this is through the 27th, so a couple of days ago, through last Friday. This chart is actually, I looked at it right before this presentation, but wasn't able to get it updated. Very similar, there's a small increase in the number of tests, but you can see this is the number of daily tests in the US. And I think this is critical because it does show that the response or the taking this health crisis seriously is really starting to ramp up. And I think that's clearly showing right now in President Trump declaring a Wartime Production Act, which basically allows the government, very similar to World War II, to determine how and where production or industrial production resources are utilized. So, so that's a really positive dynamic that I think it should be helpful to all of us, thinking that there is some light at the end of this tunnel. And then last time we had this call, we didn't really have a lot of data to show, what the economic impacts were going to be. And again, as I mentioned, it's going to be a pretty severe shock to the system. But I think what's good to see is that some of the data that has come in already, particularly out of China, because they tend to report a little bit earlier for some reason, but Chinese economic recovery is actually coming in better than the consensus had estimated. So you can see in January and February what happened between January and February, where industrial production purchasing managers index came down and basically collapsed by almost half during the month of February. But guess what happened in the month of March? This was the consensus as to is going to recover to about 45 on the purchasing managers index. This is actually what happened. They came in with a number at about of 52. Any number on this data series above 50 means there is economic industrial expansion. And I think that's really interesting because most everyone was still expecting a contraction. Now, of course, there are going to be naysayers that say we don't trust China. But I think what it does is it gives hope that this is really more of a event-driven economic sell-off with some light at the end of the tunnel, as opposed to maybe a L-shaped recovery that would see, a big collapse in demand followed by a long flat line. So, and then just for orientation purposes, the U.S. Composite Purchasing Managers Index is estimated to be down to about 40, which would be contraction, and then Europe a little bit worse than that at about 30. And we'll see, and this is something that I'm going to want to update you all on as data comes in. But I think this Chinese number is really interesting because they're beating consensus. Their economy is recovering pretty rapidly, and I think that might be a template to consider. So instead of it being a V-shaped recovery like what you're seeing in China, or a U-shape, which would be something like this, where a long downturn and then a large up, maybe this is going to look something in the US like a square root, that we have a sharp sell-off, a sharp recovery, and then maybe a plateauing for a little while. So that's our base case at the moment. I'm showing this chart because certainly I think it's worth noting And what this chart is saying is that for the US, some of the data that is coming in is obviously really visceral, really bad looking. But again, the market, I think, is already pricing a lot of this in. What you're seeing right here is what they call the weekly claims for unemployment insurance. So the number of people that are saying, hey, I'm out of work and I need unemployment benefits. And what you see here is obviously by orders of magnitude, the largest data series or the largest report ever, where you had 3.3 million people last week filing for unemployment insurance claims. You can see what the numbers were back in the great financial crisis. It was more of a gradual ramp as the economy slowed down. Same with the 2000 time period. Same with the early 80s of the other prior recession periods. But this number, even though it's big and scary, makes a lot of sense because this is an event-driven issue that's creating a lot of temporary unemployment, which is why the government has responded as large as they have with the stimulus plans. So anyway, I just wanted to point that out. I'm not trying to belittle the idea that unemployed are having a difficult go of it. I'm just saying I recognize that these are really large, ugly numbers. But more importantly, as I say up here in the gray part, the market likely knows this right now or already and is adjusting for that. So let's take a look at the market performance so far. And I think there's just a few items I did want to touch on, very similar to last week. The impact to the global economy will be severe over the next 3 to 6 months, but the markets may have already discounted much of that hit. So I think that's an really important caveat to understand. Global central banks are all responding with aggressive monetary policy. It's not just the US now, it's Europe, it's Japan, it's the Bank of China and Bank of India are all responding very aggressively to try to get out ahead of this because I think the big lesson that all the central banks learned was if you respond to a crisis before the credit market sees up, then you have a much better likelihood of surviving without significant impact than the other way around. And I'll go into that in just a minute. Global governments are all responding very aggressively too. I mean, it's not just the US that's considering a massive stimulus. I walked through last week how the German government is responding with small business loans to businesses of the largest that they've ever introduced before. Other governments globally are doing the same. So they're all trying to lessen the blow because everyone, I think, is starting to understand that this is likely an event-driven recession and not necessarily a structural recession. And I'll go into what that means too. So you can see the year-to-date picture, and I'm going to update these every time we do these events. But we did our Market Matters first one last week at about this level. Markets have obviously rallied back, so I'm not taking credit for that. I'm just recognizing that there has been a decent bit of recovery through the last week. And that makes sense to me now that some support measures are known. We actually have the stimulus bill is known. And as I'm sure you all are reading, the fourth stimulus bill is actually working its way through Congress right now. President Trump is proposing an additional $2 trillion infrastructure package, which if we all, while that might sound, big and nasty as well too, from a budgetary standpoint, I think the example of the Depression, creating the Civilian Conservation Corps and doing infrastructure projects during that day were very helpful to sustaining the American economy during the 1930s. But we got a nice bounce is kind of my point of this slide in the equity markets. And which type of bear market are we in? I mean, by definition, once you go down 20% or greater, you're in what they call a bear market. A bear market is just industry jargon for a 20% drawdown. I think the key is, and I found this slide, I think it's certainly worth pointing out, that it's important to have a concept or an idea of what type of bear market we're in. And there's 3 different kinds. If you go all the way back to the early 1900s, and you look at every recession since the 1900s, they all kind of fall into 3 different categories. And they are a structural decline, which is the result of a market player causing a systematic problem like the banking system did in 2008, which was certainly over leveraged at that time and created systemic issues that were not solvable with anyone else but the federal government. A cyclical slowdown, which just says that, hey, we've had a nice go of it for 7 years. The economy is now reaching max employment, and inflation is starting to rise through wages, and that usually causes the end of the cycle because employment can't really get any lower. Everyone's got a job that wants one, and people generally are happy. And then you also have this other category, of which there are a few examples, where what they call an event-driven recession, which is an unpredictable shock to the market, such as a natural disaster or a health crisis. And that's critical, I think, to understanding how we should be looking at the current situation and the time it's going to take to get out of this. So the average decline, interestingly enough, in an event-driven recession is 29%. Last Tuesday, we were down 31%, so pretty close. The average length, most importantly, is 9 months. So if we think that we're in a recession starting in February, then we should expect sometime in September or August or September to be on the other side of this, which I think is pretty consistent with the fact pattern of our current situation with COVID-19. And average time to recover is 15 months. So from the end of the recession, you're looking at 15 months, which is a much shorter time than it would be for a structural or a cyclical recession. So I think that dynamic is at play here, and that's our kind of base case assumption. Most importantly, I was telling you about last week about how the Fed was creating some very specific support programs for the commercial paper market, for the corporate bond market through the ETF structure, and a few other things. And our thoughts at the time were, until the corporate bond market starts to recover, then we're not going to get too excited about any recovery that we're seeing. And I think the fact that we're seeing a recovery in most of the sensitive or the key credit markets is important. So for reference, this is a year-to-date performance of 4 different bond markets. So you've got in the red, that's the aggregate bond market, which is basically U.S. government bonds, U.S. government agency bonds like Fannie and Freddie, and a few corporate bonds. The corporate market, investment grade market, is this blue line here. The emerging market, dollar-denominated bond market is in pink, and the high-yield bond market is in green. And I think the blue line is really what we need to be most focused on right now, because in a flight to safety, the red line or the government bond market is going to do really well. The corporate bond market is worth paying attention to, because this has been the area that has been, I think, most at risk to a drawdown because of the leverage that the corporate sector has taken on since the great financial crisis. And the fact that we've rallied really hard in the corporate bond market, I mean, much more so than the equity market, going from a down 18 to a down 4, or a change of 14% greater than the equity markets, is a really positive sign to say that I think we can start believing that the recovery or the rally here might be a real thing. Now, certainly we could dip back lower on equities, but the key is going to be what happens in the corporate bond market. And I think that, and the reason that is because the bond market is much larger than the reason why it's so important. The bond market is so much larger than the equity market by orders of magnitude, something like twice the size of the equity market in the US. Here, now that we've got a bill passed through Congress and signed off by the president, it's called the CARES Act, Coronavirus Relief Act. And here, I'm not going to go through all of these big bubbles, but I thought this chart that I actually found on NPR's website did a good job of explaining where money is going to be allocated, how that's going to fall out, and what I think should be nice to note here, or important to note here, is that there's a number of different support measures, and it's not just for small sectors of the economy. It's for both small companies, big companies, individuals, the healthcare sector, and other safety net type programs. So this was a big step forward. It's going to go a long way to providing stability to key sectors that are being impacted right now, particularly the airline sector and the air transport sector. And I think that's a really positive dynamic. So, and we haven't even started seeing the benefits of any of this quite yet. Moving to the how much lower can the markets go? Well, as I was saying last week, we have no crystal ball necessarily to say, that 31% is the be all end all, and that's as far as we're going to go. But there are tertiary indicators that can help give us an idea of what fear is out there. And, I think when there's a lot of fear out there, that tends to be a good buying opportunity. And one way you measure fear is through, as I mentioned last week, the VIX index or the volatility index. The volatility index measures the amount of insurance buying or put buying on the S&P 500. And just the way to read this chart is, as this VIX indicator goes up, it means more and more people are buying insurance, which means they're getting more scared, more panicked. That tends to be not a good time to be buying. However, as this indicator comes down or goes lower, it tends to be a very good time to be a buyer or at least start buying, because it means that fear is starting to come out a little bit, coming from seriously anxious levels or big anxiety levels. The fact that this is coming down, I think, is a very good signal. The other chart I showed from last week was the CNN Fear Greed Indicator. And what you'll notice is there's been a pretty decent bottoming process coming off of this indicator. So what it shows you is that as this line goes down, that means people are engaging in activity that would represent there's a lot of fear out there. So this is a composite index that represents not only put buying, but also percent of stocks above their 50-day moving average, credit spreads that I talked about last week, and other various indicators all into one kind of composite index. The fact that people are starting to get less anxious, less fearful is actually, I think, a really good thing, because coming off lows, that's always important to see. And then I will show this again because it's such a powerful chart, because people vote with their capital, not necessarily with what they tell you. And that particularly applies to insiders. And just for those of you that weren't on the call last week, this is the same chart, but I continue to see evidence of an insider accumulation, which is really positive. When the line goes above 1, that means insiders are accumulating more shares than they're selling. Any reading below 1 means that insiders are selling more shares than they're accumulating. You can see the average or the normal range of this level is 0.5, meaning that they're selling twice what they're buying. Here we've got a reading that says they're buying 2 times more than they're actually selling on aggregate. So CEOs and company insiders are voting with their capital, and I think that's a really positive dynamic, particularly because we don't get to these levels very often. You can see the last times we got to these levels. So moving to current positioning, I did point out we rebalanced all accounts between March 13th and 14th. We continue to hold short-term liquidity needs in cash. So I think that it definitely goes a long way to giving clients peace of mind that their capital will be there for withdrawals over the next 6 to 12 months. And that's more or less the recommendation that we're putting out there for the amount of cash to have on hand. From the equity side, there have been a few changes since last week, and we are adapting to this new environment. So we still have a large company U.S. overweight, which has been additive to performance, given the difference in return between the S&P 500 and the small cap index. We are now adding to active international mutual funds exposures for some of the benchmark strategies. And that's primarily because we're starting to see really wide dispersion now between some of the active strategies that we're using in our accounts versus benchmark ETFs. And it's in a positive way, obviously, otherwise we wouldn't be doing it. So we're looking at maybe increasing that over time. On the fixed income side, we still don't have a very large position to non-treasury holdings. We have most of our fixed income is in conservative corporate investment grade bonds. But with some of this uncertainty that happened, as I showed you over the last few weeks, it is opening up a number of different opportunities in the corporate, but also in the municipal bond space. And that we have been buyers of muni bonds and corporates at very attractive levels for those accounts that have individual bonds as holdings. And just by way of reference, over the last 15 years, muni bonds, as you all may be aware, have traded at a lower yield than treasuries because muni bonds are tax exempt at the federal and state level. Well, fast forward to today, and muni bonds have actually almost a 2 times higher yield than treasury bonds right now. Same credit rating, AA, AAA in most cases, and still double tax exempt. So the muni market is definitely a place where we see opportunities and will likely be area that we continue to add to, especially if these dynamics persist. And then also, I did want to touch on the alternative space. Last week, the MLP space still looking really interesting. I've been very selective with what we're doing in that space. Biotech, not as attractive because it's rallied a bit, but we're still looking to get potentially some exposure there through some liquid vehicles. High yield really hasn't sold off enough for us to get excited about it quite yet, but we're definitely looking, or not necessarily hoping, but we're just waiting patiently for opportunities to get more active in high yield. And then on the REIT space, as I mentioned, REITs were off as of last week about 41 or 42% from their recent highs. Still have a lot of question marks around tenant policies, forbearance, and how that's going to all be impactful to REIT cash flows. But certainly we're at a pretty decent starting point for REITs, and we might look at that as an option here in the near future. But I do think that, again, for those that weren't able to join us, I'll probably be continuing to add this slide for almost all of our presentations, because the recent time period in March does underscore why you don't just want to sell now and wait things out. And here's exactly why. And this would apply across every time period that I've analyzed. This just happens to be one of the longer ones that I've come across in the data series, and also it's a pretty dramatic example. So what this chart says is, if you were fully invested from 95 through 2014, remember that pulls in 2 recessions, the dot-com bubble as well as the financial crisis. Your return in the S&P would have been about 9.8%. If you would have missed the best 10 days over that, that time period, that 20-year time period, or roughly 7,000-day time period, your return would have dropped by more than 300 basis points or 3 percentage points. You missed the best 20 days, you're down to 3.6. And look what happens when you miss the best 40 days. You actually have a negative return over the 20-year time period. That, to me, when I saw this, was shocking. But interestingly, and this is key, I didn't realize this until I put some time into thinking about it, but the 6 of the 10 best days occurred within 2 weeks of the worst days. So it just tells you how difficult market timing can be, because I know there's a lot of people out there that say, hey, why don't we just sit in cash and just wait for a new opportunity? And certainly, for clients that are coming to us with just cash, that are not coming from an invested standpoint, we will definitely look to use what we call an average-in approach, which is we'll split that capital up over 3 to 6 months and average it in over time. But if you're coming from an invested standpoint, there's no reason to be out of the market right now. And this is what I mean, just in a graphical display. This is the daily change in the S&P over the last, call it 45 days. And you can see why this is so difficult, or why it would be so difficult to time doing this. So you can see plus and days where you're up or down, -6 to +6, -5 to +5. It's just a really difficult thing to do engage in market timing. That's why we don't do it. But certainly there are ways to mitigate risk, which are, I think, completely separate from what this chart would suggest from a market timing standpoint. Moving to some of the longer term positions, I feel like I didn't do justice to the charts last week, but what this tells you is that this is the average investor allocation to equities across the United States. And this is data that was pulled in from Goldman Sachs, and also from, I think it's based on Federal Reserve data. But it basically just says, on the left-hand side of the scale, This is the investor allocation to equities. The right-hand side of the scale shows the forward 10-year annualized return. And what it shows you is that it's a pretty tight match, which is one reason why I like this chart. The fit is very tight. But what it says is when investor allocation to equities gets lower, your forward-looking return on this side gets higher because it's an inverse scale on this side, meaning that at the depths of the financial crisis, your forward-looking return and realized was about 12%. Same thing back in the 90s. But look what happens when you get to high levels of investor allocation. And the dot-com bubble would certainly show you that you were expecting negative returns at the peak in 2000. Similar to 2007, we were getting really close here starting into 2020. And we were obviously at that time getting more cautious, as you may recall. But now look where we are. We're at a point where forward-looking expected return is somewhere in the neighborhood of 6 to 7%. That's really not a bad starting point, I think, especially when you can add return through other ways, through active strategies and the like. I did just want to remind everybody, this is that chart, why we need to, it's time in the market, not market timing, that makes the biggest difference on a long-term financial plan. So this shows you the periods where you had a 25% drawdown and the forward return, 1 year, 3 year, 5 year, and 10 years later. And I think the net of it is in every time period, 10 years later, you had a positive return. So in 61, 62, 70, 80, 77, and the like. Same with 5 year. I think every time period was still positive. 2 year, there may be 2 years still positive. No, I'm sorry, 2001 was the 1 year where you didn't have. And the 1 year is kind of a toss-up, but give it time, and the markets or the S&P will work for you. And this is just an update for the political side of the house of where we sit in the prediction markets. This is from predictit.org. It's a great website. I highly encourage you all to take a look at that. But this is informative because it does show that now Joe Biden did get a nice big bounce to see, after once the COVID crisis started, as it appeared that the Trump administration wasn't putting a lot of effort into it. Now it does appear that the markets are saying that he's at least the most likely candidate to win based on more recent experience of what he's proposing and things of that nature, whereas Biden's fallen off a little bit. So no real commentary here, just, I think it's a useful tool to say, all right, now that we're getting closer to the election, how should we be positioning? Currently, no recommendations quite yet, but we'll certainly update you as we get closer. And here's just some key takeaways before we get to some questions. So the recent market movement does appear to be an event-driven market economic disruption, and I think that should help everyone conceptualize that this is going to be a much shorter recovery period than it would normally be with a structural or a cyclical drawdown. Global governments and central banks are responding very swiftly, and this is the key before the financial system is seized up. And that was the big problem with 2008. Was that the Federal Reserve and the federal government allowed not only Lehman but also AIG and other banks to collapse to some degree before they decided to take action. This time around, they got out ahead of it, it looks like. Lower prices across most asset categories do make for attractive entry points here, and it is, I think, a time to buy, but it's not the time to buy. We're never going to have this is the time to buy signal, but I think we can certainly continue to add to positions even after those that we did on March 13th. And we are still in a bear market for stocks. There's no question about that because we're still down 20%. Weird things can happen during this time frame. So it is important to have portfolio resilience to make it through, to have some staying power through this whole ordeal. And that's by way of having cash on hand, having some ultra short-term bond strategies in place so that you can draw on those to make risk investments when the time is right. But also other strategies. And I'm going to actually go through some of those other strategies on the next webcast. So with that, similar to last week, we're not going to do any voice calls only because those can be a little cumbersome to manage. But what we do is I would encourage you to send any of your questions you might have through the chat function. Well, I'm going to try to get to a lot of those. But before we do that, I did want to point out some actions that our team at Gratus are taking today. And this might just speak to how we're a bit different than other firms. So in the investment team, at this point in time, it's highlighting the benefits of a rigorous investment process. So some of those activities that we're doing that would, speak to the rigor in our investment process would be things like talking with all of our fund strategies managers that we've got currently implemented in client portfolios. It's really important to keep track of what they're doing and also what changes they're making, most importantly. We're also stress testing analysis of the individual stocks that we own for a number of different reasons, so that we're best positioned not only to come out on the other side of this, but also from a dividend payment standpoint, because obviously a lot of our clients are depending on dividends and income off the portfolio for lifestyle. So we certainly want to make sure we live up to those obligations. And as recent additions would suggest, we're looking at companies that not only benefit or can benefit or prosper through a challenging market environment, but also benefit on the other side. So, names like Citrix Technologies is one that we added recently. Cisco Systems, both of those have webinar business units that are thriving right now. But also companies like Pfizer or Abbott that are developing either vaccines or testing kits. Interesting anecdote. Abbott Labs is now indicating that they will have a test ready, a 5-minute test, so that once you give a test, once you submit your blood for the test, you'll have results back in 5 minutes. That's still in the clinical trial phase right now, but if they get that to market, that will go a long way to getting test results out quicker. On the advisory team side, our advisors are hard at work on your behalf. And their day-to-day right now includes some of the following. So evaluating, client asset allocations to make sure they're appropriate, stress testing financial plans, and that I think highlights the benefit of working with an advisor for sure. Looking at the provisions of the CARES Act to see if there may be any planning opportunities. So, I think a lot of the details around the plan are still becoming known by the wider financial industry. So they're pouring through some of those details to see if there might be some application to some of the plans we have in place. And most importantly, our advisors are on the phone with clients every day, addressing any of their concerns, discussing portfolios, reviewing their plans, and generally just being there for them. And I think that's a huge benefit as we all go through this challenging period for the financial markets. And even, through my interactions with peers and other firms that I deal with, I know most financial advisors aren't taking this type of approach, the proactive approach. So if there's someone that that you can that we can be of service, that would appreciate these types of services that we're offering, we'd love to see if we can help in that endeavor. So please, let your advisor know or let us know, and we'll certainly be happy to help as many people as we can. Again, certainly want to encourage everybody to try to flatten the curve here. From a adoption standpoint, please try to abide by the CDC guidelines for social distancing, basic hygiene around hand washing and hand sanitizer, not dealing with sick people, because the sooner we get this thing nipped, the better for everybody. I do appreciate your time today, and I look forward to speaking to everybody again in the future. So we'll talk to you later. Thanks.